Good morning, all. Welcome to this week's briefing by Genghis Capital and FX Pesa. My name is Chachilo Gutru. I'm the head of research at Genghis Capital. Later on, I'll be joined by Mark Lee, who will run through the global segments. There are two handouts that we've shared. That's the weekly cross-asset strategies, and also there's a topical note that we put out mid-July, which is also related to this week's briefing. In interventions, there's the questions function, which you can use, and we'll be able to respond accordingly. So I'll start the presentation with the macroeconomic segment. I'll start with the review and also the outlook. Last week, we saw the July Purchasing Managers Index, that is the PMI, coming in at 54.2. That is the first in 8 months, which is above the neutral 50 mark, which was pointing towards expansion in terms of the private sector business sentiment. Just to give you some text, the second quarter, which was heavy with containment measures in the nation, averaged 39.4. So obviously at 50.2, that was a bounce back. And one of the things that caught our eyes in that report is that the lifting up of the cessation of movement was one of the factors that fed into this rise in optimism. And some of you who are in social media could relate with the positive vibes that came from those memes once the lifting of cessation of movement was announced. That was early July, and somehow this also percolated through the respondents' feedback. But having said that, there's some area of uncertainty in the current environment, so I don't think that this uptick will relate to positive business sentiment or in terms of capital investment by some of the private sector funds. So that is where we put our caution going forward. This week, particularly on Friday, we're expecting two key reports. One is the fourth quarter of the last financial year. The quarterly economic and budgetary review report will be out by this Friday. And one of the things that we put out last month was now the ordinary revenue, the performance over the course of the financial year 2019-2020. It was down by 40 billion. What was the targeted? Actual came to around 1.575 trillion, vis-a-vis 1.615 trillion that was targeted. Of course, there are some revisions that were made in the course of the financial year in terms of the ordinary revenue collection. So what we'll also be looking at in this report is also the expenditure by government in terms of development expenditure, recurrent expenditure, and all this accounts to around 13.2% of the gross domestic expenditure. That is one of the things we'll be keeping an eye to see how government spend its funds over the course of the last financial year. The other one is the fuel pump price review. This is out on a monthly basis by the Energy, Petroleum and Regulatory Authority. Just looking at the average in the month of the benchmark, Abu Dhabi National Oil Company, ADNOC, in short, Maban, the price for the month of June was $36.34. We haven't seen the numbers for July out yet, but just looking at the global reference crude, which averaged the end of July, it was around $43 per barrel. We are seeing that even the pricing for July will be up by around $7 per barrel. In addition to that, there's the depreciation of the Kenya shilling against the dollar to the tune of 1%. So the pricing of oil, the benchmark, and also the depreciation of the shilling feeding into these fuel pump price reviews, we are expecting an uptick in the fuel pump prices of petrol, kerosene, and diesel in the next review for the period 15th of August up to 14th of September. Moving on to the equities review for last week, both the indices, that is the NASI, Nairobi All Share Index, and the NSE 20 were down by 2% and 2% respectively over the course of last week. The turnover jumped by 90.4% from lows of 1.53 billion in the prior week to 2.91 billion across last week. Foreign participants, we saw them higher from 59% from the previous week to 82% last week, with net flows reversing the positive trend that we saw last week, registering an outflows of 136.8 million over the course of last week. Having said that, I think that there could be a bit of an inflection point. Last week's webinar, we mentioned that the prior week, there was sales of 49.4 million shillings. And if you look at even last week's outflows at 136.8 million shillings, and we compare it to the previous 5 weeks outflows to the tune of 737 million, we are seeing that there is a bit of some fatigue in terms of sell-off by foreigners. And at some point, we'll see the buyers from the foreign side starting to come in mass, and we could see a reversal of the NASI and the 20 shares. And we know that foreigners run the current bourse, so that is what we call the headline activity, which we'll be looking out for. So that is what we are forming. Is this an inflection point? Probably not, but we are seeing that there's a change in sentiment. Even if you look at the international sovereign bonds for Kenya, we saw that they have started to come from the highs, the yields hit highs on March 25th across the 5 papers that are currently being issued. And right now we are seeing that they averaged 2% decline, 2.5% decline from March 23rd. Over the course of last week, during that period, there's been a 2.5% decline in the yields at the international Eurobonds for Kenya. Now, moving on to what is our calls for the week. Majorly, we are still biased towards the stocks with a strong buffer. On the banking side, we have buy recommendation on KCB, Equity, ABSA, and also Cooperative. On the non-financials, heavy on EABL and Safaricom in terms of our buy recommendations. And moving on to specific names that we are recommending for this week. The first one is Kenya Re. Last week, it started the first half earnings with releasing a net profit increase of 45.9%. That's close to 46%. To 1.68 billion shillings. So that was quite impressive in our view. But just looking at the price of this current stock, we are seeing it's screaming a long-term buy for deep value investors. One of the metrics in our report, the cross-asset strategy, is the market fundamentals. This page is on the last page of the report, the 5th page, and we are seeing some of the metrics that we keep an eye on. So one of the metrics is price to book. Now, in short, is P/B, and it has 0.2 times. And if you compare with the industry, that is the insurance industry mean, it's around 0.57 times. So you're seeing that the Kenya Re is quite cheap as the industry, so it's attractive. And looking at the current market price, it's around 2 shillings and 38 cents. It's lower than the net cash per share, which is 2 shillings and 77 cents. So that is screaming buy for people who are into value investment. The other recommendation that we have is on Williamson Tea. It's announced a dividend payment of 20 shillings per share. The book closure is next on Tuesday. That is on the 18th of August. Against the current market price of 143 shillings, 20 shillings dividend payment is representative of dividend yield of 14%. So right now, most counters in the NSE are not giving out dividends because of just trying to cushion their buffers. But those names that are paid dividends, we are quite bullish on them. Hence, Williamson Tea is an attractive buy at the current in this week's outlook. Moving on to the fixed income segment, I'll start with the review and also our recommendation. Last week, secondary market declined to 33% to 14.6 billion shillings. T-bills performance registered, it was an uptick from the previous 119% to close to 135%. And yields across the 91-day, 182-day, and 364-day T-bills registered a slight uptick, 5 basis points on average. The top sale that was offered, it was a success. That was this paper that was being offered was a 20-year paper that was issued in 2018. Basically, the success was attributed to the high liquidity in the current environment, coupled with the pricing. We found that the pricing for this top sale was quite attractive. It was quite cheap compared to getting it in the secondary market. So those are some of the success factors that we saw that led to the uptick in this top sale. But having said that, those liquidity trends, it was quite patchy. On Wednesday session, we didn't see CBK coming in to mop up excess liquidity. So whenever there's excess liquidity in the banking system, CBK comes in to mop up the excess liquidity. So on Wednesday, we didn't see CBK coming in to intervene. And having said that, just looking at the 7-day term auction deposits, the average rate decreased by 45 basis points to 4.48%. On the other side, we saw that the interbank rate edged up by 22 basis points to 2.49% in the course of the week. This week, I think that the infrastructure bond that is still on sale, the 11-year new infrastructure bond, the amount that is being offered is 70 billion shillings, and we'll put out the pricing in next week's cross-asset strategy. So this week, we like the 5-year paper that was issued last year, entry points at around 10.2% and to 10.25% levels. We are seeing that the high liquidity in the market is it's attractive for shorter-term securities, just looking at the uncertainty in the current environment. And we don't think that CBK will issue any shorter-term paper in the current environment. The strategy of the medium-term debt strategy paper is now to issue long-term papers, and that is what we've seen even in the July primary. The 15-year paper was heavily accepted by CBK to the tune of 6% of the 80 billion that was really accepted. So we don't think that there will be a shorter-term paper being issued in the current quarter. So having said that, we think that the 5-year paper is quite attractive in our view with the current goals. I'll stop it there and invite Mark to take you through the global market segment.
Thank you, Churchill. Very good. Just bear with me 1 second while I share my screen. So good morning. Thank you all for joining. My name is Mark Lee. I'm a senior trader at Equity Group and a market analyst here at FX Pacer. So I'm going to run you through some key elements of the global financial markets for the trading week ahead. So let's kick things off by running through the economic calendar. Later today, we have US JOLTS job openings for June. The data is a survey conducted by the Bureau of Labor Stats, and the reading reflects all jobs that were unfilled on the last business day of the month. It's not particularly potent data due to the lagging nature of the reading, so today's data is a reflection of June's vacant jobs, as opposed to, say, a monthly NFP or even a weekly initial jobless claims. Tomorrow we get average earnings and claimant data out of the UK. So claimant data reflects the month-on-month change of unemployment benefits being distributed by the UK government. So therefore, a rising number would signal weakness in the UK labour market. We then get ZEW economic sentiment out of Germany. The ZEW number is a reflection of a survey conducted for around 350 German investors. The participants of the survey will project their 6-month economic outlook. A reading above 0 will signal optimism. and a reading below 0 indicates pessimism. So keep an eye on the DE30, that DAX derivative, and of course Euro markets over the release of the data. We then get PPI data out of America, producer price index month on month, and the data measures the change in the input prices of goods and services. If input prices rise, some of that additional cost will be absorbed by the producer, others will be passed on to the consumer, and of course vice versa. Because PPI has a significant impact on consumer prices, central banks will monitor this number very closely. And for this exact reason, PPI data is used by traders to predict future monetary policy action. Wednesday is the standout day on the economic calendar. Overnight, we have an interest rate decision from the RBNZ, the Royal Bank of New Zealand. Implied volatility for the Kiwi dollar NZD is currently pricing in only a 1.9% chance of an additional rate cut. So it's widely expected that the domestic interest rate will remain unchanged at 0.25%. However, the press conference is going to be the primary source of volatility here. We need to look for keywords, key phrases, any changes in economic projections. Local data in New Zealand has beat expectations of late. However, the longer term outlook remains very unsteady. I'd expect the RBNZ to communicate their willingness to utilize all of the tools available to support that domestic economy, such as negative interest rates or foreign asset purchases. Late into Wednesday morning, we get UK GDP data, so month on month, year on year, quarter on quarter. And the pound has been on a sterling run of late. GBP USD is currently hovering around the 1.30 level, having rallied from 1.14 in late March. Strong GDP numbers may just be the fuel needed for cable to pierce through that potent 1.3170 resistance. It's a level that has consistently restricted GBP USD throughout 2020. Into Wednesday afternoon, we have core CPI data from the US, so consumer price index, another key reading for central banks looking to gauge inflation. We then have crude oil inventories, so a key metric for the current state of supply and demand in oil markets. Remember, a reduction or a draw in inventories is going to be bullish for the price of oil. An increase or build in inventories is bearish for the price of oil. Thursday, we have employment data out of Australia, so keep an eye on that Australian dollar overnight. Then we have initial jobless claims data from the US, an increase of 1.14 million jobless claims are expected. Then on to the final day of the trading week. We start with industrial production out of China, such a major exporting powerhouse in the global game. So this figure will tend to move global indices across the board. A healthy Chinese economy that's improving both production and exports, that signals global demand, particularly within Europe and the US. Both regions are huge importers of Chinese goods. We then finish the week with retail sales data out of the US, a key metric for consumer demand and a real bellwether reading for the US economy. A relatively light week regarding corporate earnings. Most notably this week, we have Marriott pre-market later today. It's a share price that is strongly correlated to the hotel industry and consequently to travel, a sector that has arguably been hit the hardest during this pandemic. Whilst we're on the topic of a pandemic and the pandemic, be careful reading news headlines regarding rising coronavirus cases. It's inevitable that we see a rise in cases as we continue to increase testing capacity. We're simply testing more people, and that's reflecting more cases. If you look at a lot of key regions, the death rate itself remains in a constant decline, and that's positive for the global recovery. It's just something to be conscious of as the media continues to push this very doom and gloom picture onto mainstream investors. The financial destruction due to the pandemic has come more so via social lockdowns rather than the human health aspect. As a trader myself, my sentiment remains steady and optimistic, and that will swing very negatively if we start and see regional lockdowns implemented on a larger scale. So let's take a look at some of the charts for the week ahead. It's been a relatively subdued start to the trading week. Liquidity is likely being hampered by national holidays in both Japan and Singapore, but I'm sure that will change as more traders arrive at their screens as we approach the core European trading session. So it's another big week for GBP. So let's take a closer look at GBP USD, or cable as it's commonly referred to. Just pulling the chart here, bear with me one moment. Make that full screen for everybody. So we witnessed a very strong reading at NFP reading last Friday, and that really fueled a bid under the US dollar to close the trading week. As you can see there, GBP USD sold off, so that the dollar strengthening against GBP. However, if you look on a daily chart, I believe that uptrend is still intact, as you can see there. And there's bottled up demand. We've witnessed two pullbacks in the last week, both of which were bid back up quite quickly. As you can see by the wicks on the candle here, that pent up demand, buyers willing to step in. If we can break above the 1.32 region, then I'll show you here, we're going to look, I believe, to test December's 1.35 level. So again, a key level. If we can break through this, the upside is there. So I remain bullish on the technical setup of GBP USD. Fundamentally, I'm slightly more cautious on the future of the Great British Pound, but not to the extent of my US dollar outlook. Diminishing yields on the US dollar and stabilizing stock markets have really weighed heavily on that safe haven dollar of late, and I don't foresee that changing in the short term. Just exit full screen here. Tying into the dollar again, we've seen XAU pull back from all-time highs, an all-time high of 2075. So the price of gold versus the US dollar. Just make that full screen. And price action has been very choppy of late. That'll be better represented on a 30-minute chart. As you can see, very choppy in both directions. But don't be too blinded by these recent pullbacks. I suspect that there's an element of profit taking contributing towards these short-term sell-offs, but technically it's still a very, very strong market. I always let the market make my decision for me, and unless the market sustains a sell-off below some key technical and psychological support levels, then I'll continue to remain bullish and very much in that buy the dip mentality. A common phrase is the trend is your friend, and the trend has very much been a trader's friend throughout the past few months. As you can see on a daily chart, a quite incredible rally to all-time highs. Moving on to US indices, let's take a look at the UT100, so the Nasdaq derivative. It's a tech-led index that has really thrived of late, and it shows no signs of slowing. A key level for me on a daily chart here is that 11,000. So I'm remain bullish above that 11,000 mark. Quite often, a real area of resistance will provide the first level of support once breached. As you can see here, resistance in that region again. We finally breached through it. For me, that's now my line in the sand. We've breached above it, and that's now the first level of support. And tech stocks have really led this global recovery, and I believe the momentum continues to lay to the upside. On the political news front, President Trump has signed 4 orders over the weekend to provide some economic relief in the form of another stimulus package. Whilst that's positive news, the deal breaker remains on whether Congress can reach an agreement by the end of the week. So ensure to keep up with the headlines surrounding another stimulus package stateside. US-China relations continue to deteriorate, We've seen hostility bubble back to the surface. Over the weekend, the US imposed sanctions on Hong Kong and Chinese officials, and they've accused Chinese hackers of targeting the US election infrastructure. Very rarely is there smoke without fire, so I suspect further developments throughout the course of this week. Then breaking just an hour ago, news of the Japanese military now on standby due to Chinese boats in contested waters. If tensions escalate, then keep a close eye on those safe haven assets. That concludes this week's webinar. Please reach out to me on Twitter at EquityMark, equity with an I, Mark with a K, with any further questions or anything you'd like us to talk about in these webinars. Thank you all for listening, and good luck for the trading week ahead.